2023 has been an intense year for anything connected to blockchain, crypto, or tokenized assets more broadly. But what are some of the things to have an eye out for in 2024? This is the NJCPA IssuesWatch podcast. Welcome back to the NJCPA IssuesWatch podcast. I'm your host for everything tech related, Stein Smith, and I'm always happy to host these episodes to really try to dive through and to unpack trends, topics, and updates that are out there happening in the headlines at other companies or in other industries even that are ultimately going to change what all of us have to think about, talk about, be educated on ourselves and help our clients better understand going forward. So I'm really amped to really right now in this episode try to break down what happened during this past year in 2023 and to try to forecast, predict, if possible, a few headlines and topics that are going to be driving the overall conversation and our conversations both internally and externally in 2024. So obviously the past year 2023 has been quite intense, right? For everything blockchain related and crypto related, right? FTX, the trial happened, and Bankman-Fried was found guilty on all charges. So now, basically, all that's left for that odyssey is to find out how long he's going to serve in prison. But on the other hand, just during these past couple of weeks, so right at the end of 2023, there have been indications, there have been press releases, there have been items leaked out to the marketplace that it turns out that as the FTX bankruptcy, right, in a parallel track has been underway, that it is appearing more and more that most of the investors who had funds at FTX are going to be getting at least a portion of their funds back. So even after all of the uh, embezzlement, high risk trades, poor controls, theft that happened at FTX, all of which have been proven now in court, don't forget. Even after all of that, it is sort of shaping up that the investors who had funds at FTX are going to be getting something back. So ultimately, it was a terrible thing that happened, but there is, I think, a at least neutral outcome of this whole debacle, right? That one, investors are going to get something back, and that two, that the collapse and conviction of Bankman-Fried has hopefully sort of cleared out some of the negative players and practices that had otherwise been happening in the space. And then on top of that, Binance, the world's largest crypto asset trading platform, has pled guilty, as well as the CEO Chang and Zhao. Both of those at the individual level and at the firm level, both have pled guilty to multiple charges filed against them by the U.S. government, including charges connected to terrorist financing, money laundering, and a whole host of other financial crimes, including the biggest fine ever paid by a company, $4.3 billion, as issued by FinCEN. So obviously, on the one hand, this past year has been kind of rough, right, for everything crypto related, and anybody out there who's been a investor in this space or been advising clients in this space for a while knows that kind of that's how this asset class has evolved, right? High highs and then higher lows. And so ultimately, as we're now having an eye out for 2024, there are a few positive headlines out there that I think are really going to drive the bulk of this conversation going forward. So one, uh, pretty much every major financial institution in the world, including JP Morgan, even as their CEO Jamie Dimon bashes crypto, and in a hearing in December of 2023, he was testifying to Congress. Jamie Dimon said he would personally ban crypto in the U.S. if he had the power to go ahead and actually do so. But on the other hand, his bank and firm have been actively investing, developing, and have now deployed their own enterprise blockchain and their own token called JPM coin. So it's always interesting to watch sort of the headlines and the talking heads on topics as opposed to what their companies are actually doing. So there are pretty much every major financial institution here in the U.S. and abroad have developed and are now heavily involved in tokenized payments, right? Either inside the bank or at the very least allowing clients to conduct transactions using Bitcoin and other crypto assets. And then adding on to that, PayPal has continued to build out their own offerings in this space. And a quick PSA there. PayPal has actually been involved in allowing crypto payments, Bitcoin payments, since 2014. So PayPal has actually been a long time player in this space, and in August of this past year, rolled out their own privately issued stablecoin. So now, basically, anybody who has a PayPal account, which which I would think most of us do, can buy, sell, and pay in, I believe, half a dozen crypto, and I believe PYUSD is also a option now. So on the one hand, this past year was bad from a headline point of view, right? Convictions and fraud and criminal activity isn't ever good for a asset class. But on the other hand, at the exact same time, TradFi and major payment processors have also been allocating quite a bit of capital into this asset class. So that's going to be driving the overall narrative going forward. That even as a few of the high flyers in this space have been brought to earth, that the TradFi institutions are now getting into it in a major way. And so, adding on to that, right now, the FASB actually passed the crypto focused ASU after a lot of asking for it going back to 2017. The FASB has finally issued the first and only still crypto focused gap guidance. And so now, basically going forward, if you are a institution that holds crypto assets on the balance sheet, and there are some criteria that have to be met to actually fall under this new ASU. But if you are a company that holds crypto, that holds qualifying crypto on the balance sheet, you are now able to mark to market. So now qualifying crypto is treated as every other financial asset should, right? Mark to market. And there are also new guidelines included in this ASU around how certain types of information should be reported, either in the footnotes or in other areas on the external financial statements. But the whole point of having those criteria now sort of codified is that the goal is to make it more understandable and transparent to investors, regulators, and all the rest, that if a company holds crypto on their balance sheet, what is it, cost basis, where did it come from, and all of that information that to us is all pretty straightforward, but it actually took quite a bit of effort, right, from the industry and from general conversation, both from policymakers, Congress, investors, all the rest, to actually have the FASB issue this ASU. So I think personally, it's an excellent first step, but it's only a first step. But it's a big first step in getting more transparency, more sort of standardized frameworks, and really better information out into the marketplace as companies, echoing back to that earlier point, as we have companies, household names, PayPal, Morgan, Citi, HSBC, Deutsche Bank, SocGen, all over the world, getting into these assets that frankly there are going to have to be better rules, and the rules focused and sort of customized for the attributes of this asset class. So I think it's a great first step. Okay, so on the other hand, right? So probably now I'm at four hands, right? So on the fourth right? There has been quite a bit of debate and controversy over the upcoming changes to uh, section section 6045 that have been a long time coming, going all the way back to 2021. These changes were a part of the bipartisan infrastructure bill passed back at the end of 21, but there has been a lot of consternation, conversation, hearings in Congress on how to implement these upcoming changes. And so after getting over 100,000 comment letters on this change, the the IRS, from all externally facing information, right? I don't have any insider information, but from everything externally facing, the IRS is planning to go ahead and to implement these changes as they are currently written. Okay. And so just a handful of items to have an eye out for is that on top of creating 1099-DA, a whole new form to allow broker dealers in the space to then uh, basically communicate out trades, gains, and losses, right? So all of that is a whole process in and of itself. But there are two other things that anybody who's trying to advise clients in the space really have to have their eye on going forward. Oh, and also just a quick note there: the ASU takes effect for all uh, fiscal years after 12/15/2024. Okay, and then the upcoming changes on the tax side take effect for all transactions happening after 1/1/2025. Okay, so all of us have some time to prep, but not all that much time. Okay, and so two of the real items here is that this broker definition that has been sort of a key part of the controversy in this changes to this IRS code section is incredibly broad. And so, as it's currently written, institutions like Coinbase and Kraken are going to obviously fall under the broker umbrella. Okay. But it's also going to include, now it's all up to how it's going to be interpreted and enforced, but as it's currently written, it's going to include also DEXs, right? Decentralized trading platforms, which by their nature don't operate as a traditionally centralized broker-dealer clearinghouse model. And so the IRS wants more information on every trade, both on the trade and on the individuals making those trades, which obviously falls under KYC and AML compliance. But if you're operating as a DEX, as a decentralized player, or clients have some funds on DEXs, many of whom do. I know folks personally, just anecdotally, I know quite a few people who have funds on both types of platforms, right? Those DEXs are not organized to collect them, to track, and to then communicate that information out to the IRS or to any other policymakers. So on the one hand, that's going to be a issue going forward, and there is some conversation that sort of bypassing this law, the IRS, and by adding on to that, the U.S. government is trying to force more investors into the centralized players or to institutions like BlackRock, Fidelity, Invesco, all of whom have also submitted Bitcoin spot ETF projects for approval at the SEC. But all of that's a whole other conversation, which I will happily have with anybody offline. But so, and then adding on to that, right? The real sort of crux of the tax issue here is that as a result of this change, as it's currently written, right, crypto investors are going to have two choices in terms of tracking trades, either first in, first out, or they'll have to go through and actually identify each individual asset as they are traded. Now, for TradFi broker dealers, that's no problem because they have that technology and they have that functionality. Most of them do. But for players in the crypto space, even the largest, most well-established centralized players, don't have that functionality to track each individual token as it comes in and out of somebody's hot wallet. And so that's going to mean that either taxpayers are going to have to default to first in, first out, which overall is going to probably create larger tax liabilities, just overall. Now, obviously, you clients who bought back in April of 21, aren't going to have that problem. But overall, right, for investors who've been buying crypto for a while, dollar, cost averaging in, that's going to result in higher tax liabilities overall. Option one. Option two is that now the tax pro, us, is going to have to try to manually sort of work through and to reconcile the trade and gain and loss information off of that 1099 DA, off of the information provided to us by our clients, and then also have to take into account that if there are tokens or assets being moved from other platforms into just a Coinbase, just for a quick example here, if you have a client who's had funds at a DEX or any other platform and then moves all of those tokens onto Coinbase, odds are there are going to be issues as to the basis of those tokens, right? Right? Because as far as Coinbase knows, those coins have a basis of 0. And so all of that is going to create quite a bit of manual work. We're trying to go through and to try to parse out which tokens moved, what the basis was, and then to ultimately track any income, profits, or any losses. And so that's going to create a whole bunch of work going forward. And again, these changes, as they're currently written, as of right now, are going to take effect for all transactions happening after 1/1/2025. Okay, so there's going to be a ton happening in crypto during this upcoming year, and I've been saying that every year now since about 2016, but it all has proven true, I think. So there's going to be a ton going on, and it's also just important to keep in mind, right, that even as you're tuning into this episode, and you and your clients might not be interested in crypto right now, as you are trying to plan it, right, there are a handful of facts that I think are worth highlighting. The biggest cohort since the baby boomers, or rather, uh, you know, uh, the incoming cohort into the workplace, right? Gen Z or Alpha, they're going to be bigger in the workforce as opposed to the baby boomers. And I believe that's going to happen by 2025. So one, right, the workplace, both in the finance space and overall, is going to undergo a a large shift. One. Two, that exact same cohort, Gen uh, Z or Alpha, are the most interested in tokenized assets in terms of investing in them, holding them currently, or trying to get paid in crypto assets. And then three, that same age cohort is going to be on the receiving end of the largest wealth transfer in global history during the next 10 to 20 years. So all of those factors, even if right now, at the end of 23 or 2024 or 2025, you and your firm, colleagues, aren't really interested in crypto, aren't doing anything with it, it is going to become more and more and more part of the mainstream accounting, financial planning, and ultimately tax conversations. And so, how do you keep up with all this? Well, there are numerous excellent resources under the NJCPA has their blockchain hub, a ton of great content there, from me and a whole bunch of other folks in New Jersey working on these issues on an everyday basis. So one, NJCPA Knowledge Hub around blockchain and crypto, great place to start. And there are multiple other sources. I know both Bloomberg and CNBC both have entire verticals focused on blockchain, crypto, uh, Bloomberg has their own crypto focused area too. There are multiple sites out there, CoinDesk, Cointelegraph, and IBM has a lot of great blockchain content out there. So it's a lot of data to process and to go through, but there is quite a bit of it now in the marketplace that is unbiased and issued by objective, uh, mature sources. So it's going to be a jam-packed year, a lot going on. But I would say I am personally cautiously optimistic going forward. And so just a few housekeeping items prior to wrapping up today. If you are tuning into this podcast and you have not yet joined the NJCPA Emerging Tech Interest Group, I highly encourage you to go ahead and to do so to be up to date on everything tech related, from automation to crypto and the whole and AI. And so joining is easy at njcpa.org/groups. And every episode of the NJCPA Issues Watch podcast, tech, tax, audit, all the rest are available at njcpa.org/podcast. Thanks. Have a great day.